Hi, I'm Troy Wangen, a senior manager here at True Partners Consulting, working in the Unclaimed Property Solutions team. Today, we're going to talk a little bit about unclaimed property and mergers and acquisitions. As businesses continue to evolve and grow, merger and acquisition activity is always at the forefront of the C-suite's mind. Unfortunately, M&A activity can increase public scrutiny for both the purchaser and the seller, which can also lead to a state putting a company under an unclaimed property audit. Unreported liabilities related to unclaimed property are often overlooked during the due diligence process and unknowingly acquired along with the target's assets and/or stock. Any company that has customers, vendors, and/or employees can generate unclaimed property. Usually, under a standard stock purchase agreement, the purchaser acquires all the liabilities of the target, which includes both the liabilities on the books of records along with the liabilities off the books and records. Off-the-book liabilities could include any voided checks and credit balances written off long before the deal took place. These could also include the liabilities of any entity that the target itself may have purchased over the years. Now, what if only assets are purchased? Well, that requires a more in-depth review of the purchase agreement and the list of assets being acquired. For example, if you're acquiring the bank accounts, did you also purchase the outstanding checks? If you purchased accounts receivable, did you also purchase credit balances? As employee retention is relatively low in these types of transactions, it's extremely important to document any policies and procedures related to unclaimed property that the target already has in place. To help protect against unwanted unclaimed property liabilities and to document best practices, we would highly recommend that the following questions be included in your due diligence checklist. Does the target have an unclaimed property filing history? And if so, for how long? Has the target ever been under an unclaimed property audit or entered into voluntary disclosure agreements with any jurisdiction? Does the target use third-party administrators to administer any programs such as payroll, benefits, rebates, or shareholder services? Does the target have internal policies specific to unclaimed property or specific policies for the handling of outstanding checks or aged credit balances? Does the target have a history of voiding or writing off aged checks and/or credit balances, or has it maintained a tolerance write-off policy? And finally, have all available bank statements and reconciliations and electronic accounts receivable aging reports been provided versus just the most recent years? Understanding these aspects of the target could go a long way in determining if you need to make a purchase price adjustment for any unrecorded liabilities, or if you want to include indemnification language in the agreement. It is also not uncommon for these deals to take place over a relatively short period of time, and the proper due diligence cannot be completed. In that case, you would also look at the acceptability of including indemnification language in the agreement. While today we mainly focused on the purchaser, it's also important for the target to understand its unclaimed property liability and the structure of the agreements to determine if they may have any successor liability, especially in asset agreements. If you have any additional questions, feel free to visit our website at tpctax.com or email me at the email address below.